we've already crossed that point where the debt is payable. It's not payable through legitimate means. The U.S. government cannot tax the American public to a degree that would allow it to honestly repay its debt. And it can't cut spending in other areas. The U.S. government is not going to cut Social Security so it can pay interest on the national debt. It's just never going to happen. In fact, whenever we get to the debt ceiling and they talk about what's going to happen if we don't raise the ceiling, the first thing they say is, well, we're going to have to default on our debt. They never say, well, we're going to have to raise taxes to collect more income so we can pay our debts, or we're going to have to cut Social Security so we can pay our debts. The government tells us right up front, if we can't borrow more money, we're defaulting on the money we've already borrowed. I mean, they admit it's a Ponzi scheme. So the only way to avoid default is to inflate. But there is no viable way to honestly repay what's been borrowed, because we've borrowed way too much. The government can't do it. In fact, if you look at the nature of the debt, in the next year, just the next year, about a third of the national debt matures, which is over $10 trillion. And when you figure the new money we have to borrow, over the next year, the U.S. government has to finance about $15 trillion of debt. Who wants to loan us $15 trillion? Now, a lot of that debt is the debt that's maturing. The people who own that debt may not want to roll it over. They may want their money back so that they could do something else with it. That's what happened with a lot of the banks. That's why one of the reasons the banks were in so much trouble and needed these bailouts is their depositors wanted their money back because they had better places to put it. Like they could just put it in a money market and earn 5%, loaning it to the U.S. government. The banks were paying nothing. And so the customers wanted their money back, but the banks didn't have it because they loaned it to the government themselves for 10 years at 1%. Or they loaned out a 30-year mortgage at 3% and they didn't have the cash. So the U.S. Treasury is in the same position. So in order to prevent all of this, they're just going to print money. And again, that's not a get out of jail free card. And I hear people say, well, you don't have to worry about the governments that borrow in their own currency because they're never going to default. Well, yeah, but Argentina borrowed in pesos, although maybe I shouldn't use Argentina as an example now. They're back on, maybe they're on the right track. But in the past, they made all these mistakes, or Zimbabwe, or there are a lot of countries that had hyperinflation. In fact, if you remember back in 2021, when inflation, the way they measure it, right, first moved above 2%, instead of raising rates, they decided to reinvent their mandate. And they said, we're targeting average inflation now. We don't just want inflation at 2%. We want a historically average rate of 2%. So Powell said, we need to make up for the fact that we had a few years below 2%. Now we need to let it run above 2% for a little while, just to kind of average it all up, which was a bunch of nonsense in the first place. But Powell was just looking for an excuse not to do anything about the inflation problem because he was afraid of what it might do to the real economy. So they made up this, this BS about inflation averaging. Yeah, nobody asked Powell about inflation averaging now because look how much higher than 2% inflation has been. And even the Fed will admit that it's not going back down to 2% until maybe 2025 or 2026. So how much lower than 2% is inflation going to have to run to bring the average back down to 2%, when right now the average is so much higher than 2%. So that inflation averaging went out the window, right? Nobody talks about it. It's like, you're not allowed to mention it. But that is the last official policy. They never officially abandoned that and said, you know what, forget about inflation averaging. All we want to do is get back down to 2%. We don't care if it averages 5 or 6 or 7%. Along the way, we just want to get back to 2%, because if that's the case, if you only have to average down low inflation, but you never have to average down high inflation, right? In the long run, inflation is going to be much, much higher than 2%, and that's what the gold market still hasn't repriced. Gold is still reflecting the belief that the Fed's going to succeed and that over the long run, inflation is going to average 2%. It's not. It's going to average much higher than that, probably average closer to 20% than 2%. And when the market has to price in gold a present value of gold given a much, much higher future inflation rate, then gold needs to be priced much higher, and it will be. Yeah, I think that gold has built a very big base around this level. It initially rose to around 2,000 in 2011, and then pulled back to 1,000, and then gradually made its way back up again to 2,000, and it's kind of been hanging out around this area, and now it's been building a bit of a base just above 2,000, and I think we've been compressing the support higher, and the resistance is there, but I don't think it's very formidable at around 2,100 or 2,150 or just above. A lot of people are still a little reluctant to buy gold above 2,000 because they've been burned in the past at this price point, to see gold pull back. But the pullbacks have been, narrower and narrower. And I don't think there's a lot of downside risk in gold. I mean, obviously, there's a little bit of an opportunity cost in that you're giving up your interest. But, there's not that much interest. And I think the upside potential is enormous relative to, the downside risk in gold from here. I think historically, if you look at, where gold is relative to, let's say, U.S. stocks relative to the Dow Jones, where the Dow Jones, close to 40,000, and gold at 2,000, gold is historically very, very cheap. Gold could be 10,000 or 20,000 with the Dow at this level. If we're going to get to a cheap stock market, which is what I think. I mean, right now we have a very expensive stock market, based on valuations and a lot of other metrics. I don't think the market should be expensive. The market should be cheap, and eventually it will be cheap, but it won't be cheap in dollars. It'll be cheap in real money. It'll be cheap in gold. But the other reason I think gold prices go much higher is, money supply and inflation. And not only how much inflation we've already created, but how much inflation is going to be created in the near future. And, you asked me earlier about, inflation. The inflation is all about money. We had a huge increase in the money supply, and that's the source of the inflation. That is the inflation. The impact that has on prices is a result, and we're focusing on prices, and we're not looking at inflation. And that kind of lets the government off the hook for creating it. And, it always annoys me when I watch some of the financial channels and they talk about food inflation or rent inflation. There's no such thing as rent inflation or food inflation, as if landlords cause inflation or the farmers are causing inflation. They're not. Food prices are going up because the government has caused inflation. Rents are going up because the government has caused inflation. The inflation is the expansion of the money supply. And even though money supply has contracted a bit recently, compared to how much it went up, it's barely gone down. And so the prices still haven't adjusted to the money supply growth of the past. And inflation is not just about growth of money supply. It's about credit, because consumers use credit to buy stuff, just like they use real money. And so if credit is expanding and now consumers take that credit and they buy stuff, that bids up prices. I mentioned earlier that credit card debt is soaring to a record high. I mean, look at the last month. It was like 4 times estimates when credit blew up. Consumers are taking advantage of credit that is still plentiful and easy. And they're buying stuff. They're buying stuff that they can't afford, that their 2 or 3 paychecks still don't allow them to pay for. They find a way to borrow the money. And so as long as credit is continuing to expand, that's going to bid up prices, and prices are going higher and higher and higher. But when you look forward to this fiscal cliff and what's going to happen to money supply as the interest rates really start to move up, because nobody wants to buy treasuries. I mentioned earlier, somebody's buying treasuries, but eventually nobody's going to want to buy treasuries. And everybody who owns treasuries is going to want to sell treasuries. And that means the only buyer is going to be the Fed. But it's not just going to be treasuries. No one's going to want to buy any U.S. dollar denominated debt because none of the borrowers are going to be able to pay rates high enough to cover the loss of value of the dollar. So then the Fed might have to start buying municipal bonds, corporate bonds, everything, and it's just, just a spiral. And so it's not just that we've had so much inflation in the past, but that we've got so much inflation that's already baked in the cake for the future. That's why the price of gold really needs to start to rise to reflect that. Right now, people just don't get it. I mean, people are still optimistic. They're still confident in the Fed. They still don't understand, what's about to happen because they don't understand what already happened. They still don't, know, how the Fed created all these problems, how it inflated all these bubbles. They still think we have, genuine prosperity as opposed to a gigantic bubble.